Your bank didn't just hold your money. It helped create the money that would replace yours, slowly, quietly, and legally. And while you were told to work harder, save more, and trust the system, the people who actually run the system were doing the opposite. They were borrowing against the future at interest rates that never touched your paycheck. This is not financial advice. This is financial education, and what you're about to hear is the operating logic behind modern wealth. The uncomfortable truth is that money is not neutral. It is a tool, and if you don't understand who controls it, you will spend your whole life feeding the people who do. In 2026, the stakes are higher than anyone wanted to admit. AI is cutting middle-class jobs faster than most people can process. Inflation may have cooled on paper, but your purchasing power still never fully returned to where it was in 2019. Housing has detached from wages in the United States, the United Kingdom, Canada, and Australia, meaning a generation is learning to rent forever. Meanwhile, the stock market keeps hitting highs like nothing is wrong as real households drown in bills. That disconnect is not a glitch. It is the business model. So here's what we're going to do today. First, we'll break down how banks actually make profits from your deposits in a way that sounds impossible until you see the mechanics. Second, we'll connect that to why governments keep printing during crises and why rate decisions from the Fed often protect assets more than they protect people. Third, we'll talk about the deeper game of concentrated power, how institutional investors and private networks capture the upside while you carry most of the downside. Fourth, we'll cover how wars, debt, and finance get welded together into a profit machine that never stops. And finally, I'll tell you the only practical way to think, work, and invest in a world where the rules are designed to keep you predictable. You ready? Because the first part is going to feel personal. Let's start with the biggest lie most people were taught about money. That banks are safe vaults, and your deposit is just sitting there waiting for you to withdraw it. Picture a normal person in 2026, you. You have a checking account for bills. You have a savings account for emergencies. You might even have a retirement account you barely understand. You think your money is yours, stored somewhere behind glass. Now imagine a bank that receives your money. The bank does not put it in a safe and admire it. It uses it. According to basic banking mechanics, banks keep only a fraction of deposits as reserves and lend out the rest. That lending creates interest income. The bank's profit is not your trust. The profit is the spread between what the bank earns on loans and what it pays out to depositors. But the dark detail is this. In modern finance, lending against deposits is not just using your money, it is expanding the money supply functionally, in the form of credit. Even if you never see a printer, credit is the printer. The bank creates purchasing power by issuing loans, and those loans become assets for the bank and liabilities for borrowers. So you deposit, the bank lends, and your money becomes part of a system that multiplies economic power. And here is where the anger lands. You were not asked whether you wanted to participate in that multiplication. You were not asked whether the bank should lend your money to someone else at interest while you earn a tiny fraction of what the bank makes. You were simply told it was safe, and you were given a percentage so small it feels symbolic. Now do a quick thought experiment. If you withdraw everything, suddenly the bank needs actual cash or reserves. That's not always available. That is why banks fear runs where depositors all try to exit at the same time. A bank can be profitable on paper and still be fragile in a run. Fragility is the price of fractional reserves. But in real life, governments and regulators don't allow that fragility to become visible. When depositors panic, policymakers step in with liquidity support, deposit insurance frameworks, and central bank interventions. If the banking system fails, the economy fails with it. And because the economy is political power, nobody is letting that happen. So what happens instead? In the crisis, the system gets fed, liquidity gets injected, asset prices get supported, and ordinary people experience it as higher costs and slower wage recovery. Now you might be thinking, okay, if banks can multiply credit, why don't they just print forever and make unlimited money? Because the system needs stability. If credit expands too fast relative to productive output, inflation accelerates. If borrowers can't repay, loans go bad. If confidence collapses, liquidity vanishes. The trick is timing. The trick is calibrating money creation so it inflates assets and maintains enough confidence to keep the machine running. That calibration is the job of central banks, and in the United States that means the Fed. In 2022 through 2023, you saw the pain of aggressive tightening. Rates rose, mortgage rates rose, car loans got worse, credit cards became more brutal. But the key point for your understanding is this. Tightening does not stop asset protection. It changes who bleeds. While households see higher monthly payments, investors and institutions reposition into assets that still benefit from global liquidity. Then, when the Fed pivots or signals stability, markets often rally quickly, sometimes before workers feel any relief. The public experiences inflation and job stress. The financial sector experiences opportunity. That asymmetry is not accidental, it is structural. Now I need you to hold on to one concept. In this system, money creation is not designed primarily to make you comfortable. It is designed to keep the credit machine alive. And when the machine is threatened, policymakers don't break the machine, they patch it. That brings us to the next layer: why printing money became the emergency solution for modern economies and why it never ends when you think it should. In 2020 and beyond, quantitative easing and later balance sheet operations became the glue that held markets together. The simplistic public story is that central banks printed money to save the economy. The deeper truth is that they saved the credit system and stabilized asset values enough to prevent cascading losses. You and I experience the consequences as diluted purchasing power. Even if inflation temporarily comes down, your lived reality may not recover. Because by the time prices normalize on some indexes, wages may have fallen behind, and rent, healthcare, insurance, and energy often keep moving. The numbers can stabilize while your life stays worse. That's the long-term damage to purchasing power. In 2026, many people have a specific emotional pattern. They remember that they survived the inflation shock, and they think survival means recovery. It doesn't. Survival is not recovery. Recovery requires wages to catch up and housing costs to stop rising faster than income. But housing is a different beast, because housing is not just an economic good, it is a financial asset, and in many markets it is owned at scale by investors who can leverage cheap financing and move slower than you can. So let's zoom in on housing for a moment, because it is the clearest example of how finance beats wages. Take a young worker who makes the average wage. Rent takes a huge slice. Home prices rise faster than incomes. If you buy, your monthly payments may be driven by interest rates, taxes, insurance, and maintenance. Even if your income rises, your housing cost often rises faster, so you wait. But waiting doesn't fix the core problem because the asset price is fed by credit, not by local wages. If institutions can afford higher prices with borrowing, they outbid households whose income is constrained. Now compare that to a rich household that holds real assets, has credit access, and uses leverage as a tool. They don't just buy, they arbitrage. While you work for wages, they work the balance sheet. And here is where the story gets truly ugly. In a system that is credit-driven, the people with assets benefit twice. First, they benefit when credit is cheap enough to lift asset prices. Second, they benefit when the system later stabilizes and their portfolios recover while wages remain stuck. You feel trapped, they feel opportunistic. That difference is not a personality trait, it is the math. Now the next question is the one most people avoid because it makes them feel paranoid. Who benefits? The honest answer is, large financial institutions and concentrated networks benefit the most from stability that protects assets. And the network that matters is rarely made of one person. It's made of relationships, information access, regulatory influence, and capital deployment. The story people tell online often becomes sensational, but the underlying mechanism is real. Wealth concentration is accelerating. The top 1% owns more than ever, and that ownership is not just in stocks. It's in private equity, venture stakes, real estate portfolios, and control of financial plumbing. And the reason you don't see names on billboards is because the system prefers deniability. Power works best when it looks like it comes from the market, when it feels like a neutral force. The more opaque the network, the harder it is to challenge. But don't mistake opacity for fantasy. In finance, opacity is a feature. It makes accountability difficult. Now I want to connect this to a concept you've already lived through in 2026, AI and the disappearing middle. For years, people were told that technology would create new opportunities. Some did. But the middle is shrinking. AI can draft text, analyze data, detect anomalies, and even generate code faster than most human workers can. When firms adopt AI, the first jobs to go are often the repetitive, process-heavy roles. Entry-level analysis, routine customer support, basic content production at scale, and portions of software development where the output is standardized. You can see it in hiring. You can see it in wages. You can see it in how skill-based advice became a joke. Learn to code? AI codes too. Learn marketing? AI writes ads. Learn operations? AI optimizes schedules. The problem is not that you weren't smart enough. The problem is that your job was replaceable enough to be automated without much resistance. And while you are being squeezed, wealth holders invest in the machine itself. They own the infrastructure, the data pipelines, and the firms that monetize the automation. That is why you feel like you're losing while the stock market rises. The upside is concentrated. Now here's a brutal question. If markets were truly fair, why would the same people who profit from financial complexity also profit from automation that makes workers obsolete? You won't find comfort in conspiracy claims. What you will find is the financial structure. Ownership captures value. Automation increases value. Ownership is concentrated. Workers are not owners. Workers get paid less than the value they create. Now let's add a second layer, retirement and insurance. You cannot talk about modern finance without talking about promises that break. Social Security faces long-term funding pressure due to aging populations. Many pensions are underfunded, and in a world with climate-driven volatility, insurance markets collapse or raise premiums, which makes households pay more for basic protection while their risk rises. So even when you think the big scary thing is inflation, another scary thing is quietly becoming the default, the cost of staying insured, stable, and housed. That's why people feel anxiety at night. They're not weak. They're aware enough to notice that the structure is not designed to protect them. Now we move to the part that sounds like a history lesson, but it's actually the blueprint for how finance works across time. Debt, war, and the capture of industries. Wars have always been expensive. You can't fund large-scale conflict with hope and speeches. You need money, logistics, supply chains, and production. In modern history, governments borrow. They issue debt. They rely on financial institutions to buy that debt. Then, after the dust settles, whoever financed the war often gains leverage over the economy that follows. The mechanism is simple. When a country is financially weakened, it becomes sellable. Not just assets, but entire sectors. Mines, steel, shipping, infrastructure, reconstruction contracts, and control of capital flows can shift to those who can finance recovery on favorable terms. That is why crises and wars are not just political events. They are financial redistribution events. This is also where the quiet power theme comes in. When a nation is distracted by conflict, the people with capital can restructure markets. And restructuring often means consolidation, pricing power, and long-term returns. You might think this is ancient history. But look at 2026. Look at how post-crisis policy decisions shape the next decade. Look at how central bank interventions change asset values. Look at how regulations shift after economic shocks. Look at how public money and emergency programs often stabilize institutions faster than they stabilize ordinary families. War is one extreme form of shock. Financial shocks are another. The logic repeats. Now, you might be asking, okay, but where does crypto fit in this story? Crypto was sold as freedom from banks, freedom from centralized control, freedom from rules. In the early days, it felt like a rebellion against the gatekeepers. But by 2026, crypto is largely regulated and institutionalized. Banks and large financial firms hold substantial crypto assets. Market makers dominate liquidity. Institutional custody is mainstream. Retail traders still exist, but they are often trading inside volatility patterns created by entities with deeper balance sheets. So the promised independence became another layer of the financial system. Not necessarily evil, just different than the dream. And when the dream fails, people blame themselves. They think they missed some strategy. They think they were too late. They think they were unlucky. They don't realize they were exposed to a market structure where information and capital depth matter more than hopes. That is the real pattern. The system doesn't need to rob you with a gun. It can rob you with complexity. It can rob you with narrative. Now I need to bring this closer to your everyday life, because otherwise it stays abstract. Picture a 28-year-old nurse named David. He works nights. He keeps his bills on autopay. He doesn't make big financial moves because he can't afford big mistakes. He saves what he can. In 2020, he watched prices rise and told himself it would settle down. Then, when inflation cooled in some categories, he believed his situation was improving. But his grocery budget never returned to what it was. His insurance premiums rose. His rent increased. He started doing what people say, which in practice means he put small amounts into an index fund because it felt safe. He also tried to dabble in a few trending assets. Then in 2024 and 2025, his car needed repairs. An emergency became two emergencies. He had to withdraw from savings and dip into retirement contributions. His plan became survival. Meanwhile, he noticed that the people around him who seemed to get richer faster were not necessarily more disciplined. They often had assets already. They had family help. They had employer benefits that were valuable. They could take risks because their baseline was secure. David thought he was losing because he was behind. The system showed him he was losing because he was positioned as a borrower of last resort. He was positioned to be the liquidity source for other people's strategies. And here's where the story turns. David doesn't become reckless. He becomes cautious. He reduces risk. He tries to play it safe. But playing it safe in a rigged system can still get you hurt. If the baseline costs rise faster than your baseline income, safe turns into losing slowly. That is the quiet trap. Now we have to answer the question that matters for the next 10 years. How do you live in a system that converts stability into profit for the powerful? I'm going to give you a plain framework. First, you need to stop treating money as a scoreboard of your personal virtue. In modern finance, outcomes are shaped by access. Access to capital, access to information, access to policy influence, and access to leverage. If you believe the system rewards effort alone, you will keep blaming yourself for structural outcomes. That is how the system stays comfortable. The system wants you ashamed and quiet. Second, you need to treat central bank decisions like weather, not as news entertainment, as something that changes your costs and your asset prices. When the Fed pushes rates higher, borrowing costs rise. That hits mortgages, credit cards, and business expansion. When the Fed keeps rates higher for longer, it doesn't just slow the economy, it also changes who can afford to hold real assets. The more you rely on borrowing for life, the more pain you feel. When the Fed signals rate cuts, markets can rally quickly, but those rallies can be disconnected from wages. Asset owners may benefit before workers see relief. That timing gap is one more reason the public feels gaslit. Third, you need to understand wealth concentration and why it keeps getting worse as AI accelerates productivity without sharing ownership. In the era of AI, the value created by automation is easiest to capture by those who own the output channels. It's not just about coding, it's about distribution, data, and capital. So the skills gap story is partly true and partly misleading. Yes, skills matter. But the bigger divider is who owns the platform and who owns the capital. Fourth, you need to recognize that the retirement promise is not a guarantee. It's a political and actuarial risk. Underfunded pensions and delayed Social Security are not rumors. They are built into demographic pressure and fiscal constraints. Meanwhile,